Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 25th of June, 2020. And on Tuesday, we produced a video entitled Precious Metal Prices Rise as US Dollar Falls, which has reversed slightly since then. And on Sunday, Yield Curve Control, another way to kick the economic can down the road. And we've placed links to both of these in the description box below. And in the latter one, we pointed out that central banks have a new trick up their sleeve for reviving economic growth, or at least surviving the downturn. Now, earlier today, Reuters produced a report highlighting 5 economic tools that central banks have left to deal with the current economic crisis. So let's take a look at this article and then comment very briefly on it afterwards. Reuters article dated 25th of June 2020. Headline: Central banks have thrown many tools at coronavirus. What do they have left? To kickstart a world economy devastated by coronavirus, central banks have delved deep into their toolboxes and unleashed trillions of dollars in stimulus. So what instruments do they have left, should they need to do more? Imminent pressure has eased after central banks in the United States, Eurozone, UK, China and Japan flung around $5 trillion at the problem. But the debate on future policy options remains prescient. This was the kitchen sink thrown left, right and centre from central banks across the globe. But what's next is super relevant, because clearly there is a limit to how much markets can rise without a more structural, longer-lasting recovery path in the economy, said Valentin van Nieuwenhuizen, Chief Investment Officer at NN Investment Partners. Another big moment could soon test policymakers' ability to do more, he predicted. Here are some tools at their disposal. 1. QE ad nauseam. Quantitative easing, first adopted in many countries during the 2008-9 crisis, is bigger and bolder than ever before. The Federal Reserve could expand its balance sheet to $10 trillion by the end of 2021, from $7 trillion now, a Reuters poll found. The European Central Bank, Bank of England and Bank of Japan may further expand QE too, while more emerging markets could embark on it. And after the Fed broke the taboo of buying junk-rated corporate bonds, could central banks add equities or emulate the Fed's high street lending schemes? Well, New Zealand Central Bank is even looking at adding foreign asset purchases to its list of deployable tools. 2. Control that curve. In 2016, the Bank of Japan committed itself to pegging 10-year government bond yields around 0%. In March, as coronavirus panic gripped markets, Australia set a target around 0.25% for 3-year yields. Used by the Fed during World War II, yield curve control can complement QE in holding down borrowing costs as governments issue more debt. The Fed will likely re-engage that strategy, said 70% of investors surveyed by Russell Investments. Doubters within the Fed point out that it has yet to prove itself in boosting inflation. It may be more palatable, however, than cutting rates below 0%. 3. NERP to ZERP. With interest rates in several countries, including the United States and Britain, at or near 0%, negative rates may seem the logical next step. New Zealand has flagged that shift, instructing banks to be ready for it by the year end. Sweden, which recently ended 5 years of negative rates, says going back would be a big step, but not an impossible one. The Fed and Bank of England have pushed back against going sub-zero, and Chinese officials too oppose it. And negative rates haven't exactly boosted growth or inflation in Europe or Japan. But don't rule it out yet. 4. Hey big lender. The European Central Bank's targeted longer-term refinancing operations, TLTROs, program currently gives banks cash at rates as low as -1%, versus the official minus 0.5%. Last week, the scheme saw banks borrow a record €1.31 trillion. Central banks opposing negative policy rates could adopt this targeted lending route, Sarah Hewen, chief Europe economist at Standard Chartered, said, adding, so you could go for the bank rate minus 50 basis points as a way to stimulate lending. Potentially, the Fed might go down that way. 5. Helicopters. For central banks that already print money to buy assets, so-called helicopter drops could follow, directly funding state spending with newly created money that's not offset by government IOUs or even by feeding cash direct to households. Such options remain taboo to some extent, but policymakers have come mighty close to them during the latest shock. The idea isn't new. It was coined back in the 1960s by Milton Friedman as an option to battle deflation, and sounds like a plausible option given stubbornly low inflation. Then there's the middle ground of modern monetary theory, which some say we're already unofficially experiencing. Proponents posit governments should just spend on healthcare, education or infrastructure without worrying about debt levels, as long as low inflation allows central banks to keep borrowing costs low. Currently, the linkage between the fiscal and monetary side is not explicit, said Guy Miller, chief market strategist at Zurich Insurance Group. But this is the direction we are moving in. End of article. So, as we can see, the tools still available we have actually covered in recent videos, but it's good to see them all contained within one relatively concise summary. Now, we're of the opinion that negative rates are likely to be considered only as a last option by the United Kingdom and the United States central banks, and they are likely to try out, if not almost exhaust, all the other options first. Having said that, that doesn't mean that negative interest rates will not be brought in eventually. So the difficulty, of course, is that should the economy fail to pick up, or worse, goes into further decline because of perhaps a second wave of coronavirus infections, then negative rates, even in these economies, will most certainly have to be introduced. Now, we're not sure we're quite there yet, but at the same time not ruling it out entirely. What we would say, however, is that we are noticing a firming again of precious metal prices. And as we've said for many months, this decade, we are confident, will be the decade for precious metals. So before we end this video, and it's very late in the UK, in fact it's 2300 hours, GMT +1, a brief look at markets and how they've closed or ended the day are as follows. The Dow Jones closed up 299 points, the S&P 500 closed up 33 points, and the Nasdaq closed up 107. The Euro Stoxx 50 index closed up 22, the FTSE 100 closed up 23, the DAX closed up 83, and the CAC closed up 47. So very positive results on equity markets, albeit relatively small gains. The dollar index has risen, in fact it did so yesterday, and today is held above the 97 level and is currently standing at 97.4. Gold stands very much similarly to the level produced on Tuesday at $1,764 and silver at $17.82. Now, the jobless claims announced today were lower than last week, but slightly higher than expectations, but not by much. And most other economic data announced has in fact been positive. But we shall provide more details on this in tomorrow's video, which will be produced much earlier in the day. But in the meantime, we'd be interested if you would share your thoughts as to which central bank instrument or instruments you feel they will continue to use and to what extent, and whether in the end you believe they will be successful or not. Do share your thoughts. Thank you so much for listening. If you haven't already done so, please subscribe to this channel, and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.